So what I want to talk about is a situation that is likely to play out in the month of June. Lower dollar liquidity in US markets and what that means for your portfolios. Lower liquidity equals lower growth, which consequently will mean lower inflation. And if the Fed shows what they're doing is working, it is bullish for the US dollar. When the dollar is bullish, risk assets typically take a hit. Inflation is connected to credit creation and money growth. And if inflation and money growth go down, we should see shrinking liquidity in the US market in the month of June. As for the debt ceiling debate, what you think is going to happen is likely not going to happen. Typical logic dictates that when the Fed increases the balance sheet or raises the debt ceiling, there's going to be more liquidity in the market and there's going to be more inflation. But it's exactly the opposite. Here's how the debt ceiling debate's going to go down. They won't agree on anything until the last minute, which typically isn't good for markets. On top of that, it is crystal clear what happens once the debt ceiling is raised. The US will rebuild their war chest at the Federal Reserve, withdrawing liquidity from the private markets. Now, 3 months from now, 6 months from now, 12 months from now, there could be a completely different story. We need a crisis before QE is implemented. Yes, we are amid a crisis, but it is not severe enough for the Fed to come in and intervene. So normally the debt ceiling is raised and life just goes on. However, the timing of this debt ceiling debate is different. The Treasury will likely resume issuing Treasury securities, causing the general Treasury account to increase. Now, the Treasury general account is a liability at the Federal Reserve. Any TGA change affects the Federal Reserve. Any TGA change affects the balance. As the TGA increases, the Federal Reserve balance increases. This lowers liquidity in the market. To put it in layman's terms, what's going to happen is the US Treasury is going to begin to issue bonds after they raise the debt ceiling, and those bonds are going to suck up liquidity from the market. Instead of investing it in equities, they're going to put it in US Treasury bonds. It doesn't make any sense. Why would you do that? But it's just how the system works. I wanted to bring this to your attention because the dollar's bullish, we have shrinking growth, lower inflation, yet there's liquidity drawn out of the market. This plays into the narrative of our overall corrective assumption that Bitcoin is going to come down to some lower prices, may create one of the best buying opportunities of the year. And this will have not only an effect on Bitcoin, but also on your S&P 500, your NASDAQ. In other words, I wanted to prepare you all for the volatility that will likely come in the month of June. That's it for today, guys. If you like the video, please give it a thumbs up and make sure you subscribe so you can get more important updates as we'll be giving them every single week. Thanks and have a blessed day.